Welcome back to the Talking Stocks podcast. We're here on this beautiful Friday, Todd and Joe. We're going to get started by just giving you a quick election recap from a market perspective. Obviously, we're no politics podcast. The thing that I found really interesting was on Wednesday, so 2 days ago, when we didn't really have much of an answer as to who was going to win, the market was soaring. So Todd, I'm interested to hear why you think that is.
Hey Joe, how you doing this week?
Doing well, thanks.
Yeah, it's been a little bit. Some things are going on in the world, Joe. Some things happen to be happening. And you're probably aware of it, listeners. That yes, there was this thing called a presidential election this week, and Joe, you and I on the show a few weeks ago, we tried to encourage everybody to avoid the risk of extrapolating their political bias towards a potential market event or market outcome. I don't, historically that hasn't been smart. And I think what we're seeing yet again this year is why you need to keep your politics and your investing in separate buckets. Because oftentimes, just when you think you figured it out, right? In your mind, you figured it out, the market's going to do something completely surprising to you, right? Because the market doesn't care about your politics. And to your point, which was simply on Wednesday, with more confusion theoretically and less clarity, we saw the market go up substantially, and then saw it go up again substantially yesterday. And it's like, what the heck?
Right. It makes to an uninformed, news watcher, whether you're watching CNBC or cable news or you're just reading up on Twitter, it seems very, very out of context. But one of the things I read, I believe it was from Axios earlier this week, it was probably on Wednesday, was an article saying that basically the reason why the markets are going up is because now it's clear that there's not going to be a clear majority either way in like the House and Senate combined. So originally, like going into election day, it seemed almost obvious that Democrats were going to take control of the House, the Senate, and the presidency. Now, from like a progress change perspective, from a political perspective, that's great. Lots of things are going to get done. Turns out the markets don't really like that. They actually like gridlock because it means that less change is going to occur. I found that just fascinating, and it makes total sense.
It makes total sense. Absolutely. When you have, the Congress controlled by one party and the presidency controlled by another, you have to negotiate. And in negotiating, you end up moving towards the middle, and you avoid these things could be completely disruptive to particular industries. So I think that is exactly why the markets have run. I mean, we talked about how you have the uncertainty of, okay, the election is coming up. That was last week. Oh, the election's going to come up. What is that going to mean? And sure enough, markets sold off. People were, getting rid of their stocks because they were concerned about, that uncertainty and maybe doing some of the extrapolation that we'd prefer people don't do onto what could happen or could not happen. And then once that election day happens, you take a step towards clarity. Right. So it's what is, are you going towards uncertainty, or are you going more towards clarity? And I think that what the market is telling you this week is that at post-election, we're getting more towards clarity because every day more votes are getting counted. You're getting closer to eventually, even if it's a contested outcome, you're getting closer towards that outcome. And since markets are discounting mechanisms that are looking forward many months, they're saying, yes, at some point we are going to have a president, and at some point we are going to have what appears to be, that kind of gridlock kind of environment, which is typically pretty good for businesses. So now you're looking at that and you're saying, okay, well, if I assume that I don't have to worry about that mercurial nature of tweet storms or something that could move me crazily up and down or whatever, and now we get back to more of a just, we'll call it a pre-2016 more status quo-y kind of environment. Okay, well, let's focus on what we should be focusing on, which is the businesses, right?
Exactly.
Businesses that we're co-owners in, right? So now you're saying, okay, I'm getting back to thinking about what revenue growth could look like, how it's a direction of operating margins, how are earnings going to look between 2020 and 2021. And yes, there is this whole big COVID overhang out there, but I think that most people are looking at it and saying, okay, we get an outcome, eventually we get some sort of a stimulus, and most likely a blanket federal everybody's shut down is not on the table. That seems to be what the market is, to me, saying.
Yes, I agree with that, and it seems like from what I've read from kind of insiders this week, they're optimistic that there will be a stimulus. Now, it's pretty clear that's not going to happen until after January 20th, but it seems like, on and after Inauguration Day, things are really going to start moving towards that next stimulus. And obviously that is great news for just about everybody, whether it be the companies themselves or, us recording the podcast and whoever's listening.
Yeah, and I mean, I suppose you could make the argument, and you saw this a little bit, you saw this big rally out of big sell-off in technology last week. Our sector ranking actually forecast that a few weeks ago, technology sliding down the ranking. We saw that sell off. We saw other groups, more defensive groups, and we saw financials, which had been ignored, kind of percolating up. And maybe it was on the idea that, well, if you did get either a red wave or a blue wave, maybe that means stimulus could happen before January 20th, and that would actually help the banks a little bit more with delinquency rates and default rates. We did, once we found out more leaning towards a Biden presidency and gridlock, we did see those financials sell off the last, 2 days ago. Technology started to take off, but financials started to bounce back again yesterday. And last I looked today, they were still going a little bit higher. So, one of the things that I would say for investors as you're trying to figure out, okay, how do I want to position as we're moving into 2021? I think that as long as that stimulus is out there as a potential, it's worth taking a shot on owning some of the financials. If you look at our research right now, insurers and regional banks would be the two places that I would focus on there. One name I would give out there is Travelers, high scoring stocks, symbols TRV, it's a property and casualty insurer. And then in the regional banks, maybe you look at something like Bank South or Ameris, so BXS, or I think it's ACBC, something like that for Ameris. Those two are both high scoring in our work. We can take a look at some charts in a few minutes too as well, Joe. So yeah, I mean, I think that's kind of where everybody is right now. They're saying, okay, well, how do I position from here on out? And I think there's some really good opportunities. But yeah, whenever you want, we can look at chart. We can do whatever you want, Joe.
Absolutely. Yeah. Let's dive in. Since you gave us a good segue, let's start with banks. So you want to bring up a chart or two of those regional banks?
Yep. In order to do that, Joe, I'm going to need you to enable my sharing.
Yes. Good old Zoom.
While I talk. Yeah, I just want to do it. So yeah, I mean, I think that what you're going to find is that, yeah, here we go.
All set. Yep.
Yep, we're good. So those are going to come up. So again, if you're on the podcast, we do also post these to YouTube, so you can see the charts. If you want to go onto the YouTube, you can see it. If not, as always, we'll do our best to walk you through it as we do every week. This chart that's on the screen right now is just simply the S&P 500 ETF, the SPY. And I just wanted to pull this up so you can see how, interestingly, we came down to that September level. We rallied back up a little bit lower than that prior peak in August, the end of August, sell back down until the beginning of the month, and then rally back off. And what's interesting there, Joe, is that, I was saying, I think it was back in here, I was saying I wouldn't be surprised. I was actually investing a little bit of my own money as we were coming down here. And I wouldn't be surprised if we undercut 320 again. We didn't, actually. We did not undercut the 320. I said I wouldn't be surprised by it, but it looks like we held above it. And, we rallied back up, and now we're coming back up into this level again. And I think that from an investing standpoint, just from a macro view, because again, 2/3 of stocks, 3/4 of stocks are going to move how the market moves. It is important to take a look every once in a while, because it can tell you, okay, are the odds more tilted toward fear or greed? Is it better for me to press bets and take things? I would say that if you weren't a buyer in here, right around here, maybe sit on your hands a little bit, see how we do up here, and see whether or not we can either bust out to new highs, which is what I think will end up happening, or where we end up rolling back down. But right now I'm modeling for a breakout, eventual breakout to new highs. And then if you don't want to look from a market perspective, we talk on a stock perspective. Let me just pull up that regional bank ETF. The KRE is the one I'm looking at. And you can see here, Joe, we got that 3-day ago big drop. And then we had that bounce back here. And I think we have here is we have an opportunity. I think you can control your risk. You can say, okay, we get down here, maybe I get rid of it. Otherwise, I'm going to hold on to it. And if you look at the individual stocks, maybe, like I said, Amyris, AB, CB is one. You've got some decent earnings growth despite headwinds, some decent top line revenue growth. And another one would be Bank South, BXS was the other one that I want to mention.
All right. Very well. So moving on, as we might not want to admit it, but let's face it, Christmas is coming. And we talked about a couple weeks ago, I believe it was, we talked about like the, we talked about the toy companies and some other retailers. And so one of the things I wanted to hone in on this week are the big retailers. So Target and Walmart, kind of Target versus Walmart, right? And we've established that Target has been scoring higher than Walmart a little bit. Both are pretty bullish, but I would say Target's very bullish. Walmart's just plain bullish. But I know that you have kind of a wild card, a third option here that might be better than those two.
Yeah, Target is one I own in my personal account. I do like it. Still scores quite high. It's a little bit higher scoring than Walmart. So I guess I would tilt myself towards Target. You're right; those toy makers have done really nicely. Mattel even better than Hasbro. Mattel was a really, really nice win. I think that as we get closer to the holidays, you are going to start to separate winners from losers. I wouldn't go down and take the risk of buying, say, a Macy's.
Yeah.
I think something like a Target is not a bad idea. I think Walmart is fine. I would actually, though, focus your attention on Costco, which is the highest of the discount stores in our research right now. And Costco has been a monster stock. It's certainly a name everybody is familiar with, especially if you invest in retail stocks. And it's not cheap. I mean, it's bumping up against its highs yet again after retreating last week. But I think there's a reason for it. You've got a company that executes, has a history of executing extremely well, that is only now in the really early innings of its digital transformation. And I think that that's the big story with Costco right now. They're a little slow relative to, say, a Walmart to embrace e-commerce, but the revenue is really been a much bigger contributor over the course of the last 12 months, and of course accelerated because of COVID. So of all of those big retailers, I would say, okay, I kind of would be looking for an entrance into Costco. Like maybe if we get down 3%, down 5% in the individual stock, maybe that gives you an entrance day on it. Then maybe Target, and then maybe Walmart.
Yep. So I'm gonna put you on the spot here, just playing devil's advocate a little bit. So Costco's a wholesale club, we know that, but Walmart has its own wholesale club. Walmart has Sam's Club. So why Costco over Walmart, I guess is the question. And the other thing is, like, Walmart I know has done a tremendous job. I don't know if pivoting is the right word, but adapting in the pandemic with their online ordering infrastructure. So from a consumer perspective, like you're hearing a lot more about what Walmart's been doing rather than Costco.
Yeah. Well, one of the things I think that we always have to remember is that stocks do follow earnings over time. So typically speaking, the companies that are generating out the greatest revenue growth with the strongest margins with the best DPS growth will be your better returners. And that's why we lean Costco or Target versus Walmart, because frankly, they've got the potential for greater. They're growing their top line faster than Walmart, Costco is, and they also are expected to grow their bottom line faster than Walmart is. So that would be the quick and dirty explanation of why I would favor that over say a Walmart. And again, Walmart's not a bad scoring stock. I wouldn't be selling it.
Right.
But maybe I'd be holding it if I was saying, okay, I only have room for one big one in my portfolio. I think I would probably wait and see if I could get Costco first and
Yep.
then go from there.
Right. Maybe try to catch Costco on a down day, because as we've established, the price is pretty high right now.
Yeah, and that's what I oftentimes, Joe, that's what I'm doing. I'm looking through our research. I'm finding those high scoring stocks that resonate with me. I'm coming up with my thesis, what the catalyst could be for it. I'm doing my due diligence, looking at the revenue growth, the operating margins, the earnings per share growth, checking out some of the other factors in our model, making sure everything dovetails with me so that I have it cleared in my head. This is a stock that I can go out and I can buy and feel good about holding on to. And then I watch for an entry point. It's different if if we were having this conversation last week because we were selling off, the market was down, everything was on sale. Yeah, just go out and hit the bid, buy the stock. Now we've had a nice rally off of it. Maybe let it digest a little bit, see if you get a little better of an entry point.
Yep. Yeah, I completely agree. Good advice. So let's pivot a little bit. The other one I wanted to cover this week, because it's been a huge mover earlier in the week and has started to rebound, is Solar Edge. The symbol is SEDG. So I know it's relatively high scoring in our model, but I think it would be good to address it at the very least. And maybe put a little bit of context behind the movement that it's been having this week, which has been utterly crazy.
Yeah, and for listeners, again, I'm swapping over to share my screen. YouTube, you can follow along with us, and you can see Solar Edge has been a crazy ride in Solar Edge since March. 67 to over 300, pulling back to about 200 and bouncing back up again. I do own shares. I do not plan to sell them. I did not sell them. I actually bought a little bit more on the draw. That being said, I actually, in our research, there's the highest, and solar, by the way, is a strong scoring group for us in the research, and it has been for weeks, which is important to know. And I think obviously, even though you do have gridlock, it is a more favorable administration that is coming in. So you definitely could see some tailwinds coming back towards that basket of stocks.
Definitely.
But one of the stocks that I wanted to mention today, Joe, was Sonova Energy. And they're, one of those residential solar plays. And just now breaking out, one of the highest scoring stocks in our universe, not just in solar. So again, this is a stock where you have to pay up for it to own it. So maybe you want to wait and see if we can get a down day, maybe buy it closer to the 32 or area somewhere in there. But this is a stock you might want to put on your list instead of Solar Edge if you didn't have Solar Edge yet, or because Solar Edge is high scoring and it is coming off of its low. I'm fine with you going out and taking a shot on Solar Edge as well. I think that, you've got a little bit of a gap to fill. There's some technical stuff going on here that you're going to want to keep an eye on, but not a bad entrance in a stock that's been on sale.
Yep. And for those who might not know, Solar Edge and Sonova, do they basically do the same thing, or do they kind of provide different products and services?
They provide different. So Nova is going to be doing more in that residential. We're doing the installs and making our money from that part of the market, where Solar Edge is actually making the inverters that are used in those systems. So they're kissing cousins, if you will. Theoretically, yep. If residential is doing better, Solar Edge could be doing better, but also commercial is going to have a big impact in that as well. Basically, if you're having more solar installed, which I think is your long-term thesis, it's my long-term thesis for owning Solar Edge. If you believe that over the next 10 to 20 years, you're going to have more solar power than less, then yeah, owning some of these companies that like Solar Edge would tend to make some sense.
Yeah, I definitely agree with that. And I would even say in the next 5 years or so, I guess we can kind of project now the incoming presidential administration, there's probably going to be, there's almost definitely going to be some favorable subsidies, rebates, whatnot, for both solar companies and for homeowners looking to install solar in their homes. So I would not be surprised if, you see your neighbor across the street or down the road putting up some solar panels in the next 5 years or so. Also, the price is just plummeting and
Yeah,
has been.
the technology's getting better, right? The price is coming down because more people have been installing them. And I would say that a headwind, meaning the prior administration, if everything shakes out the way it does as of 11:30 filming
Right.
on, I mean, if it shakes out the way that it looks like it may shake out, then you could argue that they have some tailwinds for the basket. And like you said, if that results in rebates and stuff, that would be bullish for the group.
Absolutely. All right, we're going rapid fire here today. So next up, one that I wanted to cover that we actually have not covered since we started recording this podcast is Teledoc. TDoc is the symbol. Probably one of the most kind of like prominent pandemic stocks, you might say, that seemed poised to really succeed from all of this. I know we talked, I think it was last week, about Livongo and that merger that seems to be coming.
Yeah, it's complete. It's done now.
Oh, it is.
Yep.
Okay.
Yep.
I haven't,
So
my bad.
yep. So Livongo is now part of Teledoc.
Mhm.
It's interesting. This is an interesting. I'm actually glad that you brought this one up, Joe, because it's interesting. You're right. It's a high flyer. Again, full disclosure, I am long the stock. Been long it for a while now. Have no plans to sell it one way or the other. But that being said, it doesn't score very well in the research right now. It's kind of in a holding pattern, score-wise. Not something that I would necessarily go out and be clamoring to buy more of. And I think that the argument there might be that you could say, okay, well, maybe the institution, everybody owns it, everybody knows the story, and what's left to be the catalyst. Then you've got the overhang of integrations aren't necessarily easy. There is some uncertainty on how that integration with Livongo is going to work out. Will they be able to get the synergies that they hope? Will they have the cross-selling opportunities they hope? I owned both. I own Livongo and Teledoc. So now I own a lot of Teledoc. I'm not reducing my exposure to Teledoc, but I just think that there are other higher scoring stocks in the basket that I would focus on. And then I would let Teledoc prove itself a little bit here. And then once Teledoc's score starts to improve, Joe, then you can go out and take it. But for right now, I'm fine with just sort of letting it sit and maybe focusing on a different idea. And one of the ideas that's on my radar right now, and I don't own shares of it yet, but I am watching it closely, is this Frisia. In the symbol there for people who aren't on YouTube and are listening to the podcast, Peter Hank Reagan, so PHR, and the company there is Frisia. And what Frisia does, Joe, is they help to streamline the whole patient relationship with the provider. So let's say that you need to go into your doctor's office. Well, you could go in, and rather than standing in line to wait to talk to whoever's at the counter, you could either log on to your phone through the Frisia's app, or you would just pick up one of their Frisia tablets at the entrance and go ahead and check yourself in. And it walks you right through the list of all the questions that you would normally get asked. You just do it all digitally. So it manages that part of the admittance. It ties in with the electronic health record players like Epic and Cerner and everything. So that's all a unified experience for the provider. And they also handle billing and transactions for those providers. So, that's a stock that I'm actually taking a really good solid look at. I think that's a good opportunity. The total addressable market from providers is pretty big. It's about $9 billion, and this is a company that on a trailing 12 months. I mean, if you annualize last quarter, you're talking only about 140 million in revenue. So I think there's a lot of potential and running room there. So that's one that maybe it's a higher scoring stock than Teledoc in our research, and maybe that's one that I would be more focused on putting to my watch list.
Yeah, one of the things I would point out, I forget where I heard this or if it was just kind of in conversation in the past week or so, but I know that a lot of people are like starting to think about kind of telemedicine in the long run. And I know that there are a lot of people out there who are kind of concerned about like quality of care, similarly to like to school education on Zoom. You know, it's there's still like you can get almost everything, but there's still something missing. And that's definitely the case with healthcare. I think it translates across, you know, education, healthcare, even like corporate meeting settings. And so like personally, I feel the same way, you know, and I think that it bears caution on the part of Teladoc, because, you know, we've seen the rise, right? And
Yeah, and
so,
it used to be that Teladoc was the only game in town for investors, you know,
right.
but now you could trade Amwell as well. And I think I read recently that another one's coming to you know, planning an IPO soon. So, I mean, it's not like Teladoc's the only one you can invest in. So now you're spreading it around a little bit. Investors are spreading around a little bit. And I think you're right. I mean, okay, so you know, I have some pretty severe back pain I've been dealing with the last week or so. So, you know, am I really going to, I went physically to my doctor. You know, I'm not, what am I going to, you know, I'm going to talk to my, on a virtual and say, yeah, I have back pain. I mean, he
Yeah.
needs to actually do an exam and make sure, and then I had to go get x-rays and stuff. I mean, so there are certain things that it lends itself very well to, sniffles, you know, right?
Yeah, exactly.
But there are other things that maybe it doesn't lend itself well to. And that's where we have to find out from here. You know, I think that's a huge opportunity. And I think that this is a way for the future. It's established itself, it's accelerated a lot. I love it. I still own it. I'm long it. I just, right now, I'm just kind of in a wait and see mode on it.
Yeah, I'm with you there. So pivoting once more, we're just giving you all sorts of curveballs today. We're gonna switch over to automotive, and one stock that's been pretty high scoring in our reports over the past few weeks is GM. And I look at that and I think not necessarily why GM, but it's more why now.
People are getting kind of surprised by GM, right? Because it's all
Right.
been Tesla, right? And I mean, it's sneakily these other automakers, GM and Ford actually, GM and Ford both score higher in our research right now than Tesla does, and so does Daimler. But GM is the highest scoring of those auto manufacturers. I mean, you can see here, Joe, too. I mean, you know, one of the components of the research model is money flow. We're talking about price, direction, and volume. And you see these volume spikes on these up days compared to the down days volume. I mean, it seems like most of the people who wanted to get out of General Motors are out of General Motors.
Yeah.
And we're starting to see the tide shift. You know, you had, I think, a catalyst there was kind of Nikola's disaster,
Right.
because it made people go, oh, well, maybe General Motors is going to get even more favorable terms if they do try to restructure their partnership with that, or maybe they go it alone and they don't even have to share. Who knows, right? Or maybe the market isn't going to be as spread out, including a Nikola, and General Motors gets more of it because, you know, it's got the the Hummer EV coming out and some other things. Just there could be, it may have just been that you just needed a little bit of a push in a catalyst, and that's what we kind of got, and it started to get people interested in the stock again. But one of the things interesting about this is look at the expected earnings acceleration from 2020 to 2021, Joe. 280 per share to 482.
That's
And again,
remarkable.
remember, the market is always going to do those year-over-year comparisons. So you've got 2020 being this baseline year that's pretty bad. So now you have really easy comparisons. And remember, analysts are usually late. They're late to downgrade and they're late to upgrade. So what ends up happening is that their expectations for future earnings are usually depressed. They're too low. So companies have an easier, and we're seeing that this earnings cycle, Joe, we're seeing way more companies coming out and beating than missing on the EPS. And I think that that's going to continue through 2021. And then, of course, you've got that tailwind, Joe, of, you know, people moving out of urban centers that started to accelerate after COVID in the spring. And as they do that, the need for them to buy vehicles.
Right.
So maybe you were sharing a vehicle living in downtown Boston or New York City or whatever, but now you're out in the suburbs and you want a second vehicle.
Yep. That's certainly a great point. And, you know, it's a little surprising somewhat, but, you know, when you dig down, it definitely makes sense. I
And, you know,
see you
that's,
pulling up some auto parts stores here next.
I am. Auto parts stores. I would also be looking at winter time. Interesting. We talk about seasonality on the show every once in a while, Joe, because it is a component of the model.
Yep.
One of the things that a lot of people forget is that winter is very hard on vehicles. And oftentimes that causes them to break down. So some of the busiest time of the year for auto parts stores is that winter time period. So, take a look at some of those auto parts stores. The industry overall scores well in our research. And then take a look at some of the auto parts suppliers as well, like Dana Incorporated, which is a solid scoring stock in our research. So there's plenty of those that you can, within that basket in the research every week, you can punch up. But that just gives you an idea. If you're less interested in the automakers, you might want to take a look at something like the retail stores. And if you're less interested in the retail stores, then maybe take a look at the parts players.
Yeah. Great way to wrap up. You got any final parting thoughts for us before we wrap up this week?
I do. One of the things that I think is important is to encourage everybody to welcome opposing viewpoints into their investment analysis. And I guess the takeaway, the thing I want to leave with today is just be okay with seeing someone post something on Twitter that doesn't jive with your your thesis of why you're long the stock. Oftentimes what you find is if you welcome that information into your approach, you're going to it's going to strengthen your argument, because you're going to spot blind spots. You're going to find these blind spots that otherwise you may not have found. So don't just surround yourself in a bubble of people who agree and are bullish on a particular stock or particular basket, but actually welcome in a lot of different viewpoints, and then come to your own decision based upon that homework and the research that you do following those.
All right. Very wise words, as always. Great way to wrap up. All right. So with that, we'll see you all next week. Thanks for listening.